Good morning. Welcome to the morning market briefing. Today is Tuesday, August 11th, 2026. We've got a lot to get to today. Tom sent a really interesting tweet, first to me last night, and I'm glad he did. I thought it was so applicable that he then teams it out to everyone. So I'm excited to see how many people read that when we have our investment team meeting here in about 20 minutes. But it's something that we've been alluding to here on the podcast, but was framed in terms of supply side economics and demand driven economics differently and very succinctly, I might add. But I wanted to start off with there was a Tim Rose article previewing the CPI report tomorrow. Right now, we've got the estimate that's supposed to come in at 0.1% month over month, which would be higher than the minus 0.4% in June. And obviously net prices would be down over May. And then on the core, we're expected to be up 0.22%. The previous month was down 0.02. What I think is most interesting on the core, though, is if you look on a year over year, and even if we look at the estimate, and the results have honestly been coming in lower than estimates. On the core, we've got the estimate is 2.5, down from 2.6 last month. So even with a bit of a tick up in the monthly inflation number, which I don't know if we're really going to get, you're still talking about 2.5%, which to Warsh's point, it's not 2, but you're getting a lot closer. I think a lot of people might feel like it's 4% right now, and we're certainly not close to that. So interesting as we look forward to the CPI result tomorrow morning. But Tom, I was curious what your thoughts are. Maybe first summarize what the main talking points from that tweet were, and then any opinion that you might have on that.
Yeah, so this actually came from a guy. I mentioned him last week on the podcast. He's a new Twitter follower for me, at Dr. J Strategy, but he's a guy named James Thorne, and he's an economist. And it's a really long tweet. It's probably 10 paragraphs. But basically what he outlines is that we're moving through the looking glass, and things that normally would be how we were operating the markets has flipped. And we've kind of talked about this, and I would encourage people to pull it up and read it, because it really hammers in on the ideas that we've been talking about, which is there's basically been a regime change at the Fed. And there has been literally at the very base of our economy with, the Make America Great Again, tariff-based, supply side push into manufacturing and reshoring a lot of our, bastions of American industry. And as a result, we should be considering things differently. And we've been really trying to hammer on that point, but I'll kind of summarize a little bit of what he said, but he said, quote, "Markets remain intellectually captive to the Bernanke era. High rates are always deflationary. Lower rates are always inflationary. Capital expenditure is a drag on returns. Rising equities are a liquidity bubble. In a debt-saturated market trying to secure secular stagnation, all four propositions can actually fail simultaneously. The Bernanke framework offers management, not escape, weak growth, zero rates, periodic liquidity, and financial engineering, while the America First agenda proposes the opposite, drawing on Mundell-style supply-side economics and Hamiltonian economic sovereignty. It seeks to expand productive capacity through deregulation, energy abundance, investment incentives, domestic production, and strategic infrastructure. The aim is not demand, it's more output, real economic growth, larger productive capital stock, and ultimately real earnings growth." And, if you're curious who Mundell is, he's a Canadian economist who was big sort of in the 60s and 70s. Notably, he was super anti-taxes, very much on the idea that you should cut taxes at the lowest possible rate, increase output, and that if you have a highly progressive tax structure, what you're going to get is maximal stagflation. And the irony is that piece of his work has been completely ignored. His other major idea was basically the inception of the euro. But what the Europeans did is they adopted the euro, which he came up with, but what they also adopted is the opposite of his economic thought, which is a highly progressive tax structure. And guess what? They've ended up with maximal stagflation. I mean, there's nothing going on over there. So they took the worst parts of Mundell's ideas, and then they took the opposite of his best ideas. But basically, he's saying what we've been saying, which is that the market is looking at this wrong, and particularly the mainstream financial media continues to hammer on this Bernanke idea where they need to have the Fed tell them exactly what's going to happen. We need to inject as much capital in the markets to save equities. We need to, cut rates to zero in order to stimulate inflation. We have to raise rates to the moon in order to get inflation down. But the reality is the flywheel is moving and we're creating new economic output. And, he's basically asserting that yes, there's huge capital expenditures right now in AI and in a lot of places, getting the steel industry back, out of its mothballed status. But the net effect of that is going to be positive because as you spend that money to get those things up and running, eventually they start to create value and then you have to spend less money on that. And then your return on invested capital becomes even more. And then you tie that all into that's domestic production, jobs here, and suddenly you're going to get growth, and that doesn't create inflation because your cost curve actually comes down. You spend all this money, and then it starts to eventually yield fruit, and then you only have to spend a little bit on maintenance in order to keep that going. But the effects of that investment are starting to, you put $1 in, you get $1 back, and then you get $2 back, and then you get $3 back. And that doesn't create inflation, that creates growth. And so we're moving really aggressively from a, demand side, cutting checks to everybody, printing money to the moon, importing as many people as we can, to the opposite, which is generate maximal economic value here with the resources we have. And that's going to take a little bit of capital expenditure on the front end. But what's going to happen is we're going to have real earnings growth, not pretend earnings growth. I mean, think Nike made a ton of money after the stimulus checks went out. And what have they done since then? Absolutely nothing, because the stimulus checks didn't come a second time or a third time. And he goes on to say, Besant and Warsh appear to grasp the required finesse. Japan's stagnation in the global yen carry trade left markets dependent on cheap funding and stable yield gaps. Borrowing cheaply in yen to buy higher yielding assets elsewhere has made abrupt shifts in Japanese or U.S. rates a potential deleveraging event. The objective is lower, sustainable yields, not return to indiscriminate zero rates. Bernanke helicopter money is not on the table. Yields must fall because productivity and supply improve, and to finesse the transition period from secular stagnation into economic sovereignty. So that's what we're doing. And that's what we've been trying to say on this podcast. And we've sort of been dancing around it. And it's a tough concept to really distill down to a few points. But I would say everyone should read that tweet because I think it's right on the money of what we've been trying to, sort of conceptualize as we've talked through, why are rates way too high? Why shouldn't Kevin Warsh be hiking rates into this? Why is it positive that we're spending a ton of money on AI infrastructure, a ton of money on, doing CPR on the manufacturing industrial complex in the U.S.? Why are we putting tariffs on other countries to make it such that we have to do that here? There's a lot of moving pieces, but the net result is going to be maximally growthy.
I see a lot of parallels between that reality and what China did in the early aughts in terms of incentivizing production, lowering the cost to produce, and basically becoming a massive deflationary force in the world economy because it was able to get down the cost curve so rapidly. Now, they did that in a few ways that I morally and economically disagree with in terms of indiscriminate building of cities, indiscriminately lax regulation on pay, and frankly slave labor.
Yeah.
But we're doing the same thing in terms of investment in automation and trying to become more efficient and making these capital investments that are going to yield massive benefits down the line. And I think if that cut does come to fruition, I think that's a disinflationary force that we haven't seen in the United States for decades, probably since the 90s, I would say, and maybe beyond that.
World War II, the 50s, maybe.
So I think it's very interesting from that perspective. The other piece is on Warsh. As part of that article, Timros was basically warning and saying if this CPI goes the wrong way, it could be a really, really tough 2 months for Warsh. And I don't think Warsh sees it that way, honestly. I mean, I think that the financial news media it might be a very confusing time for them, but I don't think Warsh really cares about the short-term monetary policy dynamics. even if he had to hike rates, I don't think he really sees that as a big decision. Honestly, I think that he sees bigger decisions is how do you think about it, and how do you think about what the Fed's role is, and it dovetails well with that article because I think he even uses the writer of that article says we're going from a era of monetary dominance where basically monetary policy subsidizes the entire economy to an era of fiscal dominance where we actually have the money and we're going to allocate that money in a dominant fashion where we go to high yielding assets.
There's no subsidizing at all.
Right.
The economy drives itself because it's top to bottom stronger and is not in need of constant liquidity injections.
And whether you agree or disagree with it, there was a big announcement yesterday and on CNBC, and you had Jensen Huang, you had David Solomon of Goldman Sachs, you had Jonathan Gray of Blackstone, Larry Fink of BlackRock, Apollo's head, KKR's head, Brookfield Asset Management's head. They were all on CNBC yesterday talking about a $500 billion essentially fund that they're all putting together with private capital, and not NVIDIA money, but private capital that's going to be used to fund this AI build out. This is a return of fiscal dominance. We have a lot of capital in the United States and we're putting it to work. Larry Fink made the point, David Solomon made the point, there's a lot of money in money market funds that can come into the market. They did make some assumptions, which I think are dangerous, and it's all predicated on the premise that chips, these NVIDIA GPUs, do not depreciate, and in fact may even appreciate because their value goes up, and the amount of revenue they're able to generate actually increases over time because of their software stack. It gets me a little bit worried from that perspective because I think depreciation, especially in technology, is a thing. I don't think that we should be financing chip purchases the same way we finance a house. And Larry Fink did make a comparison. He said this is kind of the early days of mortgage-backed securities, like in the 1970s.
Yee.
And so I think there are some concerns there. That said, I do think there are a lot of smart people looking at this, and there are asset-based lending facilities out there for even things like airplanes or vehicles. I mean, how many GM credit trusts are there out there?
A zillion.
Or American Airlines, aircraft bonds. And I think there is room for that. You're not going to get a 10-year facility to back the purchase of a GPU, but maybe you get a 5-year facility that pays back principal over time.
Yep.
And that is capitalized at 50%
loan to value.
Yeah.
I mean, that's how they do planes. I mean, we're buying a lot of these during the zero interest rate environment, but you could basically go say, hey, here's a American Airlines ABS bond. And what they're doing is they don't want to pay for 10 planes up front. That's not how they do it. What they do is they basically do the same thing you do with a car. They put 20% down, they borrow the rest, they create a credit facility that becomes a bond, and then every time they make a payment, you get principal and interest back, just like a car payment. And over time, eventually, they don't really owe that much on the planes, but while they own that plane, they're flying it around and it creates economic value in the same way that you drive your car, but you don't own it outright, particularly in the first 3-4 years. And then eventually the amount of interest is not that much. And again, same idea. CapEx is big on the front end. You pay a lot of interest in the first couple of years. That goes to bondholders. But then 2 or 3 years in, you don't really owe that much on the plane, but its economic value has not gone down. It's still, we looked at tail numbers on these, and, there was one flying from like Dallas to Seoul. There were some Airbuses. But you get a basket of planes all wrapped up into one thing. And instead of being like, I'm attaching myself to the financial health of American Airlines, which is a dicey proposition, what you are is buying those assets. So in theory, you could take possession of, or at least some portion of those planes if you wanted, which I would be much happier doing than any part of American Airlines equity.
Well, let me ask you this question, Tom. Would this bond be attractive to you? A 5-year amortizing bond from Oracle that's backed by GPUs. And NVIDIA has guaranteed 25% of the value, and it's collateralized at 50%. So you're basically, if you think NVIDIA is in a AAA, which is an assumption, but they have a lot of cash, then your max downside is 50% if Oracle defaults and you have no residual value on those chips. But you're already at 2-to-1 collateralization.
I mean, it's going to depend on
and I said you can get 8%.
Yeah, and if the structure is such that I get sunk out on a chunk quarterly or monthly, then I'd be more. That would be how I'd be more incentivized. In the same way that mortgages pay, where it's certainly the moment you buy that bond, you've got the most risk. But if everybody pays their mortgages for 3 years, suddenly you exit the risk zone and you get in a position where you can't really lose money. Knock on wood. I mean, you could have a default and lose a ton of value, or maybe be flat, but your risk of loss goes down very quickly if you have a return of capital structure like that. And most ABS is structured that way. So I think it'd be pretty interesting. I don't know that it would be appropriate for clients, but if I was running a large diversified fund, like a mutual fund or an ETF, I mean, I think it would be an interesting piece to have in there. And I mean, you could argue that the enhanced equipment trust, which are those airline bonds, were on the edges for a lot of clients, something that might be too esoteric to really justify putting in an account. But those have paid very well all through the rising interest rate environment because you get paid that money up front. In fact, you get paid the least amount of money towards the end of the bond. It basically just becomes a cash position. All the yield is front loaded because of those sinking amortization pieces. So, it's kind of a weird structure where it's like you get all the money up front and then it just kind of cruises the last year, as opposed to most bonds, which are more flatline returns. So
it's interesting, but I mean, it shows how, I know we kind of got into the weeds there, but it shows how the finance industry in the United States is really kind of trying to take charge of this.
Yeah.
And it's not relying on government spending, and it's not relying on zero interest rates to make it work. And in the context of interest rates that are the highest they've been in 20 years, the fact that we're able to make these capital investments is partly a function of the financial industry and the financial services. Now, there's plenty of flaws with that, and there's going to be potential of plenty of unintended consequences, especially with the profit motive there. But it's something to say this is different than what you see in China. It's different than what you see in Europe. Last thing today, NFIB Small Business Optimism Survey was quite good. The summary here is that it was the highest level since last August. Underneath the headlines, you did see uncertainty tick up, but general business conditions are looking more positive. What's interesting is if you look at the plans for hiring and the expectations for growth, and both picked up significantly. Hiring plans went from 11 to 20, which is the highest since September 2022. But actual hiring was -5, which is the lowest since last June. So if you look at this NFIB Small Business Optimism Survey and say, which is a big assumption, that this is actually what's going to happen and it maps out what's going to happen over the next 6 months, then you would say this is the weakest point for employment, and it's going to get a lot better from here. What's also interesting is price plans are falling. They've fallen for the last couple of months from 34 to 32 to 28, which is a fairly decent level. And actual prices are falling as well from 36 to 38 to 31. So inflation's coming down. Only 14% say it's its biggest problem, down from 21% last month. Capital expenditure plans are the highest since really July 2023. Actual CapEx remains range bound, but again, the plans for hiring, the plans for CapEx, the plans for overall business conditions are improving. We can't have any craziness over the next 6 months, but there's a degree of optimism in the small business community that we haven't seen for the last 6 months.
Things are good. Things are a little nutty, but they're good. I think but the difference is people don't understand what's going on. That's why I got the boys and our good friend, Dr. J Strategy, trying to explain it.
Yep. We'll see you tomorrow. Have a great day out, though.